So we begin with the big issue, considering a different risk going into 2020.
One of the things the market's not positioned for.
Tremendous surprise to the upside.
Big upside in 2020.
Everything going right in 2020.
It's got to be about profits.
Have to see earnings grow more than 5 or 6%.
You catch a lot of people by surprise.
There's still a consensus for a retraction.
Here we are at new all-time highs.
Momentum could certainly continue into Q1.
And the glass seems as half empty as ever in terms of people's attitudes.
The economy is stabilizing.
Data actually rebounding.
Central banks are flooding the economy and the markets with liquidity.
All of this will fuel some form of a recovery.
Without fundamentals materially improving.
It takes time sometime for the fundamentals to assert themselves.
Bigger risk that people aren't prepared for is much better performance.
So the key question for this program is the biggest risk, upside risk. Joining me around the table, Patrick Palfrey of Credit Suisse, Morgan Stanley's Mike Wilson, and Robert Tipp of PGIM. Patrick, let's begin with you. Your thoughts on that going into 2020?
Well, I think right now the upside setup is particularly strong. We have an industrial backdrop that appears to be accelerating, and with that, that should lead to pro-cyclical leadership within the market. That's really what's going to drive success within equities in 2020.
First half story for you, though, not a second half story.
Well, we think the bulk of the gains are going to be generated in the first half, simply because that's when we're feeling this acceleration. As we get to the back half of the year, we don't see a problem. We just think it's going to be a front half loaded year.
Does some of that resonate with you, Mike?
Yeah, we're in the same camp. I think probably for a little bit different reasons. We think it's more liquidity driven than fundamentally driven, but that's fine. I mean, that's what markets are built on, liquidity, and liquidity is extraordinary. And we've seen it really since October 11th, when the Fed announced its non-QE, QE program. Since then, we've seen a dramatic rotation to high beta cyclical stocks, and we think a lot of it has to do with liquidity more than it has to actual evidence of an upturn.
Walk me through the channel here. What is it about the balance sheet operation that the Fed is currently conducting that is feeding into broader risk assets at the moment? Is it just sentiment, or is there a direct channel there?
There is a placebo effect where people treat it as QE, so they say I'm protected. But the real, we've written about this extensively, it's in volatility. So S&P realized vol now is at a 100-year low. I don't know about you guys, but it doesn't feel like a 100-year low vol market to me. It shouldn't be. So, that's a mispricing, and that has attracted significant inflows from, systematic strategies who target vol and CTAs, which then also forces active managers to keep up. So I think it's working like a charm. I don't know if that's the Fed's intention or the ECB's intention or the Bank of Japan's intention, but it's part of their intention because, look, they haven't been able to get inflation for 20 years. But they've been very good at getting asset inflation. And here we go again. And so you just, that's the game.
Robert Tipp, your take?
Yeah, I think it's going to be, in some respects, more of the same but different. It's going to be tricky. I think it's going to be, on average, a more positive year than 2018. But it's going to be similar in that it's going to go between very low volatility and very high volatility. Even with equity vol, you'll see realized days in the single digits, and then you see it pop up into the high teens and into the 20s and then back down. So I think people are looking at, this should be a good year. It's probably going to be this, probably, stable rates, better equities, tighter spreads. But you're going to kind of pogo stick between the extremes of fear and greed as the backdrop has subtle shifts.
What is it that you're seeing that you think will unlock bouts of volatility through the year? Can you identify anything at the moment, Robert?
It's so many things. I mean, on the one hand, if you get stronger economic data, people will fear that'll shake the Fed loose. You could have a revamping of ECB strategy where they want to work like the Riksbank and make their way towards zero to reduce side effects. You could have the economy, which honestly I think people are underestimating how bad things are on the manufacturing side. I mean, we've had several months of really bad data. If things don't get significantly better, then people will begin to
underestimating it,
so I
or
think
are they just getting comfortable with the
before you
idea
get to the politics.
that it's not going to bleed into services? Isn't that the story of this year? It's not that they're underestimating industrial output or manufacturing. They're just getting comfortable with the fact that it hasn't gone through to the rest of the economy, in the United States, in Europe for that matter as well.
Yeah, but I think what happens is you have the service sector growth. Your manufacturing side is not doing that well. And your inflation numbers are slowly moving up. I mean, we've had basically 5-6 years of core inflation slowly moving up in the U.S., slowly moving up in Europe, and that keeps real wages from having strong growth. It's just a dangerous backdrop. It's not terrible,
yeah.
But I think when you're that imbalanced, it increases your downside risk.